Well, good afternoon, everybody. Thanks for joining us for the JS Mindset Weekly Call. My name's Denny. Today is Saturday, June 20th, 2020. It's the first day of summer. On the call today, in addition to Jim Sinclair, Bill Holter, and Dave, we have a very special guest joining us. There are some really great detectives that the good Lord has shared with the world, and I'm not talking about Sherlock Holmes or Angela Lansbury in Murder, She Wrote. I'm talking about the real, honest-to-goodness detectives that have unraveled the most difficult challenges an investigator could tackle. Einstein unraveled E equals mc squared and the relationship of energy in the universe. Isaac Newton broke down the puzzle of physics so that the world could understand matter and force and equilibrium. Good detectives are not only brilliant, they are tenacious. Some people would call them stubborn. But they never give up when they're faced with incalculable puzzles. Today's guest is one of the world's greatest detectives. Ted Butler is an economics detective of the highest order in that he has again and again figured out how the economic crooks have rigged markets and rigged systems to fleece the rest of us. If you've never read his work, you owe it to yourself to visit butlerresearch.com. That's butlerresearch.com, and you'll treat yourself to an economic autopsy on the precious metals markets. His writing is easygoing, it's straightforward, and absolutely eye-opening. He joins us today on the JS Mindset Weekly Call, and we are delighted to have him. Ted, welcome, and thanks for joining us.
Well, thank you very much, and I hope I can live up to half of that introduction.
You'll be aces, don't you worry. Ted, I am going to compare you to an old television show. There used to be a television show on air called Quincy, and Quincy was played by Jack Klugman. He was a pathologist that could always catch a murderer. No matter how clever they were, he would catch them. In the metals markets, in the COMEX and future markets, you are our Quincy because you've been able to track down the thieves who have manipulated our metals markets for so very long. The first question is, why'd you get started in doing the detective work on the manipulation of the metals markets so long ago? What was the trigger point that got you involved?
Well, it goes back to around 1985, and I was, as a commodity broker at the time for Drexel Burnham Lambert, I had a client by the name of Israel Friedman, who was smart as a whip and a real top-notch, I won't call him a commodity trader, he was a commodity investor that took positions in commodities that weren't short-term in nature. Anyway, make a long story short, he had been very successful in silver and bought back in the late 70s at around the $4 mark a few contracts of COMEX silver, which he paid full cash value for and took delivery of. So he didn't hold them on a futures basis. He took them on a physical basis, paid for them, watched the price run up to near $50. He got out at about 40, little plus 40, and got back, 10 times his original investment, and would qualify as a great success. After 1980, when he did get out, when the price did hit its all-time high at that time, over the next few years, the price came right back down again. And to the $5 or so mark and remained there. He challenged me to come up with the explanation for why silver was so depressed in price when at the time it had a documented shortfall, a supply deficit. We were consuming more silver than we were producing, thereby depleting world inventories for many years, and it was something that stood in the face of legitimate supply-demand analysis. When you have a shortage of a commodity, the price has to go higher. Because silver wasn't going higher, he challenged me to find the reason as to why it wasn't going higher. It took me a year, which seemed like an awful long time back then, to figure out that the reason silver wasn't going higher was because there was so much trading and particular short selling taking place on the COMEX, the world's leading precious metals exchange, that it depressed the price and kept the price down. And again, it took me a year. When I found out about it, not only did I inform Izzy about it, I started to write to the regulators and the COMEX, the exchange officials. It was crazy. It didn't stand up to the way commodities law was structured and intended to work, and began a campaign of attacking what was a concentrated short position, a giant short position by just a handful of large commercial banks, both foreign and domestic. And basically, it still exists to this day, and I've been on the mission of trying to expose it and get this thing to see the light of day. So that's the background.
That's quite a background, and all because Izzy just challenged you to get into it.
Absolutely.
Ted, you have one of the best explanations of what gold leasing is all about. So take us back to school. Some of us are going to hear about gold leases for the first time today with you, and others of us have put up with this nonsense for so long that we just appreciate what the simple analogy of what took place many years ago with this financial vehicle known as the gold lease. Can you break it down for us, just exactly what was the gold lease?
Okay, first of all, leasing is very much a misnomer. It's not the word that should be used when we're talking about precious metals leasing. Precious metals leasing is an oxymoron in the sense that a bar of gold, a bar of silver is not a utilitarian item. It's not like a car or an apartment or an airplane or a piece of equipment that can be lent out and used by others for some productive means and in turn paid a rent for that usage and then returned at the end of the lease with appropriate depreciation and loss in the event that the item is basically used up. But we equate that, and they use the term leasing to apply to precious metals, gold and silver, when it's not the right term. What's happening in a precious metals lease is that the original owner of the bar of gold, for instance, contracts with a separate party who will borrow, supposedly, take the physical metal, the gold, off the original owner's hands, not give the owner the full proceeds of taking away the physical possession of the metal, the gold in this case, and then this third party would turn out, this second party who was taking the gold, supposedly borrowing it, would immediately turn around and sell the bar of gold to an independent third party who had nothing to do with the original lender. I'm using you got to put quotations around these terms, because the original lender, the original owner, is not part of the transaction of the middleman, the person who borrowed the metal from the original owner. He just sold it to a independent third party and took the money. The guy in the middle took the money, kicked back a very small amount, of rental income, supposedly, to the original owner. But the whole thing is a scam, because you can't use a bar of metal. A bar of metal by itself is of no practical use to anyone. The only use you can get out of a bar of gold or a bar of silver, is either to sell it to somebody else and take the cash in, or to use it up in either jewelry or industrial consumption, which in effect destroys the item, and renders it as not being able to be returned. So what we should use instead of the term lease or lending when it comes to precious metals, it is a short selling transaction, because the middleman, the guy who's taking the metal off the original owner, is just borrowing the metal in order to sell short to a third party, And the whole thing hinges upon the financial capability of the middleman returning the metal someday. Now, the problem with that is that the sale, the short sale, or the lease, whatever you want to call it, is not denominated in dollars. It's denominated in metal. And therefore, physical metal is borrowed and sold at the outset of the lease, and at the closing of the lease, physical metal has to be returned regardless of what the price is at the time the metal is supposedly returned. This is what got Barrick Gold, Anglo Gold, Newcrest Gold into severe trouble around the turn of the century when they forward sold. They borrowed gold from middlemen, from central banks, and from bullion banks, sold it into the market, these mining companies did, and then used the proceeds in their operations. The problem was they borrowed the gold, at $300 and didn't get around to returning it too late after they realized their liability till the price was closer to $800 or $1,000, and in which case Barrick Gold lost about $10 billion in the whole deal. Anglo Gold the same, and Newcrest close to that. So it was just a misnomer. There's no such thing as legitimate precious metals leasing. It's all a short-selling transaction, and I would say scam, because it's proposed as a lease when that's preposterous.
Ted, you've also warned the likes of these large gold producers over the years that continuing to sell future production, they knew that it was obviously suppressing the price of gold, but that ultimately the practice was going to cost them dearly. You warned them of that. Their stockholders probably had no idea that you were looking out for them at the time, but you were. So here's the million-dollar question. Has the practice of forward selling of gold production stopped?
Yes, it has. It's a thing of the past. You won't find, gold miners, gold producers doing what they did 20 years ago, borrowing physical metal, selling it into the market to get the proceeds, and then promising to return it one day. That, fortunately, is a thing of the past. I doubt it will be resurrected anytime in our lifetimes. So that's the good news is that gold, precious metals leasing, the way we knew it, where the mining companies were involved, is basically a thing of the past and good riddance. Where it has come up, though, where precious metals has come up, is not so much in gold. There may be a little bit of that going on. But where the precious metals leasing has come up recently, say over the last several months, is in the leasing, or short selling is the better word, in silver, where tremendous quantities, 100, 200 million ounces of silver, physical silver, have come into and been deposited in the big silver ETFs led by SLV, the biggest, but also 5 or 6 other well-known and legitimate silver ETFs to the tune of, close to 200 million ounces over the last couple of months, 3 months, say. And despite this tremendous flow of physical silver that's come into these ETFs, which equates to almost the entire world mine production over this time, the price has not gone up. I mean, the price of silver is still lugging around. It's off from the contrived extreme lows of mid-March, but it's no higher, in fact, lower than it was at year end. And the question is, just like Izzy asked of me 35 years ago, I'll ask collectively to everyone else in the audience, how can you have 200 million ounces of physical silver being bought in just in 3 months okay, and deposit into the world silver ETFs, okay, without the price going up. You can't have a situation where more is being bought of a commodity than is being produced and the price not rise. And the answer to the riddle, I'll save you the time, the answer to the riddle is that someone, and that someone being the bank J.P. Morgan Chase, has been loaning out this metal, this silver, okay, to other banks who in turn are selling it to these ETFs. And I say it's a fraud and a scam of epic proportions. Why would J.P. Morgan do this? Okay, it is a hidden motive, and that's basically that by engaging and luring in my opinion, these other banks, okay, to serve as middlemen to take this leased silver and in turn sell it to the legitimate silver ETFs, okay, J.P. Morgan has put these other banks who are borrowing the silver into a deeper short position than they already were in as a result of these banks' short positions in COMEX futures. Unbeknownst to most people, J.P. Morgan has kind of slid out the back, Jack, okay, of their short positions on the COMEX, and not only have they done that, they've further indebted, in my opinion, these other banks into going short. These banks are already big short on the COMEX, and now they're even bigger short in the lease market because this metal that's being leased is just a short sale, and these banks who have been borrowing it are indebted now to J.P. Morgan to return this metal someday, at regardless of what the price may be at that time.
One of the things that Jim Sinclair has always said, that pretty soon there will only be one mega shark that has eaten all the other sharks. When J.P. Morgan dumped off this short position to all the other banks, clearly they still got to collect on that short position. They still either have to have the silver restored or whatnot. I watched the central banks dump off their gold reserves in the gold leases the same way. They just kept dumping them off. But at some point, the gold has to be returned to the central banks. The silver has to be returned to J.P. Morgan. Or will this not be the short squeeze of all short squeezes, Ted?
All of the above. All of the above. It's like an atomic bomb on top of a neutron bomb on top of a hydrogen bomb. It's a short position on top of a short position, and the legitimate question comes up, okay, assuming that I'm correct and that this metal that has been flowing, a couple of 100 million ounces that have been flowing into the silver ETFs, which is easy enough to document, if it's really coming from J.P. Morgan in the form of a lease, the question's going to come up, how the heck are these banks going to be able to pay this back? And I would submit that the first function of any bank, including the most crooked of all, J.P. Morgan, is to assess the ability or inability of the people that they're lending either money or metal to, okay, to pay back that loan. So while we may be concerned whether J.P. Morgan is going to be compensated for the metal that it has loaned out to these other banks, I would say that J.P. Morgan is not concerned about that because they never would have lent it in the first place, and they know the other bank's ability to pay back. We happen to be in a situation where it's said, I assume it's true, it's said repetitively that whatever economic conditions we're going through right now, that the banking world is better off, much better off than it was at the last financial crisis. Whether that's true or not, I don't know, but if it is true, then these banks have plenty of ability to pay back, either in metal, but I would assume that J.P. Morgan would take money in return, but based upon the then current price of silver, which is not going to be the current price of silver.
I thought J.P. Morgan was pretty slick when they dumped off their subprime loans in the last 2007-2009 fiasco. They dumped them off to the Federal Reserve. This one's a little bit different. They only have two alternatives, Ted, as far as accounting's concerned. They either show it as an allowance for doubtful accounts. In other words, a bad loan, we have to accrue for that in our 10Qs, which is public reporting, or they say, well, to hell with that. We won't take ounces. We'll take the cash, as you've said. They come out clean as a whistle, and the rest of the banks, the silver just disappears. But again, at one point, they are not going to be able to hide the shortage of silver or the shortage of gold any longer. Any predictions of when that's going to happen?
That's likely true. I mean, that's at some point, but that's at the payback point. People don't start taking, or banks don't start taking allowances for bad debts the same day or the same month that they make the original loan. And these loans are just being made now, so there'd be no provisions for any kind of not being paid back anytime soon. This is going to come, down the road, and at a different financial regulatory regime and different circumstances completely. They just put this stuff out. They're not that concerned about getting it back now. They want to get it back mañana, but at a much higher rate, a much higher price of silver.
All right, Quincy.
Hey, Denny, I got a quick question. Ted, you're saying that the metal's got to be returned or the cash returned. And let's assume, which I don't assume this, but let's assume that the banking system is in better shape than it was in 2008, 2009. So it's in better shape, and we're talking about $17 silver. Okay, so the banks certainly can assuming that they're in okay shape, they can make that payment. But how's that going to be done if you have silver at $100, $200? Pick a number. Pick any number. And then on top of that, where exactly does the silver come from? Because when silver gets sold into the market, it gets used more so than gold.
You're correct. Yeah. No, I don't think at $100 or $200 it's going to be that much of a difficulty for the banks to either financially settle with J.P. Morgan. They'll be out many tens of billions of dollars. Okay, at that point, the problem is if they don't settle up by then, by 100 or 200, then the real damage can kick in if as and when prices go much higher than that. So it's I don't think there's a problem. We lived through $50 silver a couple of times. The world didn't come to an end. There's a lot more money out there than there was back last time silver hit $50. So I don't see $100 or even $200 putting any big bank that's doing this necessarily out of business. But if they
how
don't,
about $2,000?
That's what's going to drive the price up is going to be these banks realizing that they've been hoodwinked and snookered, and they don't know it yet. I mean, if they did, they wouldn't do it. It's they're looking at this as it's an expedient thing. Oh, look, I have an order. I have to put into the SLV 10 million ounces this week. Where am I going to get it? And here comes the friendly guy from J.P. Morgan. Say, look, you don't have to buy it. I'll lend it to you. You just pay me back someday, and it solves the problem then and there. But that's the history of financial disasters. Is putting off until tomorrow what should be done today.
Ted, I have read about all of the letters that you've sent over the years to regulators and authorities, letters to the COMEX, letters to Alan Greenspan, the Treasury Department, and even the Federal Reserve. I'm flabbergasted that they have never done anything about it. First of all, did they ever respond to you, and what are your thoughts?
Well, I have gotten responses, over the years. I got a response back from the, I think the letter that I sent about leasing to the Federal Reserve and the Treasury Department, from both agencies, kind of minimizing it. And, look, first of all, I'm an outsider. I'm not, someone that is in a position of somebody being at the Federal Reserve or the Treasury or a big bank or a big exchange. I'm nobody. They're not inclined to listen to outsiders. People don't even want to listen to their wife to tell them to do something they know they should be doing. So an outsider coming in and telling you how to run your business, the natural reaction is get lost, okay, in a nice way perhaps, but get lost nevertheless, particularly if it threatens an ongoing and lucrative flow of income, which if they were to admit, the exchanges, the COMEX, that they're running essentially some kind of a bucket shop, which they are, then it's going to deprive them of business, and they're not going to do it. They're going to resist it. So while I've gotten responses over the years, okay, polite in most cases, to very pertinent questions, the interesting thing is that since 2008, okay, when the primary commodities regulator, the CFTC, the Commodity Futures Trading Commission, responded for the second time in a 16-page public letter in May of 2008 to my concerns about the concentrated short position in silver, COMEX silver. They dismissed the whole thing in this 16-page public letter, which is on their website in May of 2008, and said there was no problem with the concentrated short position, but they conveniently left out that the largest single concentrated short, who was Bear Stearns, went bankrupt, I say, mostly as a result of their gold and silver short position on the COMEX 2 months before the date of their letter, the CFTC's letter, saying that there was no problem. I mean, how much of a bigger problem could there be if the biggest concentrated short, Bear Stearns, went out of business and was forced to be taken over by J.P. Morgan, which in turn took over Bear Stearns' short position? You can't get a bigger problem than that. Yet the CFTC essentially lied and said there was no problem and please go away. But the interesting thing is that since that time, and with all the events that have pointed more and more to J.P. Morgan being the biggest single crook in the gold and silver market, okay, and now they've double-crossed and hoodwinked the other big commercial shorts on the COMEX and elsewhere, the CFTC has gone silent. They haven't commented on all the things that have taken place under J.P. Morgan's reign of terror in the gold and silver market. It's going on 12 years. I send them every single article that I write. When I say them, I send it to every official at the CFTC of any worth. I send it to Jamie Dimon and the board of directors at J.P. Morgan. I send it to the head of the CME group, which owns the COMEX, and their top regulatory official. I send it to all of them, and so I don't get it returned. Okay, I don't get blocked emails or anything like that. Whether they're reading the stuff or not, I don't know. I don't know what
Ted,
the heck they would be reading.
Ted, they're reading it. You know they're reading it. You're being humble at this point. In fact, they're
not answering. I'm just, I'm in the dark here.
I called you Quincy, and I think I mischaracterized you. You're more like Peter Falk in Lieutenant Columbo, where you know you've got them and they know you've got them. You just have to keep asking questions until they convict themselves and say, okay, you got me. The question is, are they ever going to do that? I don't see that. How much longer do you think they'll be able to continue these illegal activities?
Well, it's interesting that you mentioned. I happen to agree with you. I think enough water has gone under the bridge, okay, and so many accusations, allegations have been made by me over the decades, okay, that there's no way that the CFTC or any government exchange is ever going to come out and say, oh, you know what, we messed up. We should have been on top of this 10, 20, 30 years ago, and we're gonna fess up and we're gonna set things straight now. Those days are gone. That's not going to happen. I'm kind of doing it now just to cement the case, okay, and explain to people exactly what's going on. But the reality is, it's going to end. It isn't going to end because the CFTC or the COMEX suddenly sees the light and says, you know, wait, we got to do something about this. No, it's got to be forced on them, and that's what's happening now. It's like the steps that J.P. Morgan has taken to, just hoodwink and double cross the other big shorts. That's how it's going to end. I mean, the minute that J.P. Morgan says, okay, now we've decided we're not going to lend any more silver, physical silver, so you guys can supply the demand that's in the ETFs, it's over. Now, at what minute and what hour and what day that takes place is impossible to say, because you got to be able to read J.P. Morgan's mind, and that's impossible. But the stages, I don't know how they get out of it. I don't know how this thing gets resolved quietly. When it gets resolved and how it gets resolved is just a matter of, it's inevitable. The precise moment of when it gets resolved is unknown, but it's got to be closer than it has been in the past. Look, I don't have another 35 years to wait anyway, but besides that, the events in the world seem to be suggesting this is coming to a head sooner rather than later.
I want you to put on your...
Denny, I got a quick question.
Go ahead.
Ted, have you ever wished that someone would sue you?
Well, I
mean, get to the discovery phase?
Yeah, well, not when my wife is around, okay, but it's yeah. I mean, I've kind of in the early days, I was quite worried about it. I used to look out the window and see if the process servers were showing up. As time has gone on, and as I've gotten older and no longer being in a position of having to, say, support a young and growing family, the fear has kind of dissipated. And I don't know if I wish that they would sue me, but I wish they would at least challenge me or come back with some kind of substantive rebuttal, or just something. No, you're wrong. We're not doing that. We're doing this. I get all my information from public data. I don't know anybody inside information. I'm a lone wolf, and I peer over the data and that the CFTC puts out and all the public information. That's the only contact that I have, and I base all my allegations on that. And I would like to see the agency, for instance, that is providing this data to take issue with my interpretation of their own data. But I can't get that. And, it's frustrating, but at the same time, it's somewhat confirming and comforting that, boy, if they could mush a Boston cream pie in my face and show me that I was really off base, I know they would do it. I mean, it's
Ted, I want to go down a different line with you here, and starting at the part, things have to make sense. So this whole idea of leasing gold or silver just seems stupid. Dave and I have been in business, and we've leased equipment and tools and trucks, but we were doing something that we used to complete a construction contract and make money.
Sure.
But I don't just understand why somebody would lease gold. So I go back to the point, why would they do that? It's because they're trying to hold down the price of gold as compared to their currency. So then I start thinking, well, this could be a hell of a conspiracy. I mean, nobody's stupid enough to lease gold without some sort of backhanded or behind-the-scenes knowledge that this is untoward and the system's rigged. So I'm very suspecting of a conspiracy in this whole process, probably beginning with the central banks. Now, am I out in la-la land and in the giggle weeds? Any thoughts on that, Ted?
No, but you're speaking in terms of gold. You're speaking in I think in the past tense. In that I don't think it was some kind of back around 1995 to the year 2000 when silver too, but gold, precious metals leasing and mining forward selling, they were joined at the hip, was popular. There was probably a couple of smart guys, rocket scientists on Wall Street who concocted and conceived the whole thing that really knew what was going on. But the average central banker and the average miner, I think they're basically sometimes as dumb as dirt when it comes to grasping the full situation. So I don't think everybody was involved in this massive conspiracy to depress the price of gold and silver at that time. It had the effect. What they were doing had the effect of depressing the price, but I don't think everybody was aware of it. As time went on, it blew up in their face. The price went up. They couldn't return it. The metal had accepted a big loss. Okay, it's done. They're not going to do it again. Once bitten, twice shy. What's happening now in silver is a little bit different, okay? There's no mining companies involved, okay? It's strictly J.P. Morgan, one crooked bank, the big crooked bank, to other crooked banks, lending out this silver, and these banks are in turn providing the silver to the ETFs. I don't think it's going on in gold as pervasively as it's going on in silver. It's possible it's going on a little bit there too, but it's not the old leasing that was shown to be fraudulent and a scam that everybody just forgot about. I mean, nobody came out and declared that this was a fraud and a scam 20 years ago. It just conveniently died, and everybody swore off ever having to do it again. And it's not going to be done, I don't think, in our lifetimes where mining companies, today they can buy put options and this and that. They don't have to resort to borrowing metal from central banks. This business about silver that I'm alleging, which is very recent, it's not the last 3 months, between J.P. Morgan and these other banks for the purpose of going into the big silver ETFs, is different in that there's no mining companies involved, and it's not like publicly displayed. Nobody's kind of aware of it, so it's kind of snuck in the back door. I don't think it's long lasting. I think J.P. Morgan has a boatload of physical silver. I've said 1 billion ounces they picked up over the last 9 years. And they've lent out 100, maybe more, 200 million ounces of this metal that they've accumulated. I don't think they can loan it all out because then, you get to be too obvious, and these other banks are going to wake up at some point and cry foul if they're put too deeply into a short hole that they can't possibly recover. Then they'll cry foul and fraud and everything else, and it'll be a big mess. I think J.P. Morgan knows this and is not going to go, overboard in lending out, every single ounce that it has in its possession, even though if there were no practical limitations, they might. But I think we're kind of at that point where they're kind of almost loaned out as much silver as they can loan out without the people on the bad side of the equation waking up and realizing, like you're saying, that there's no legitimacy to this. It's like, what the heck are we doing here?
Ted, in a poker game, it comes down to when somebody calls. In accounting, we always say there's got to be an audit. We've got to audit this. We've got to count. We've got to see where things are. In a poker game, that's called the call. Prove it to me what you have. What the problem has been is there's been no audits of gold stocks. There's been no audits, for instance, Fort Knox. Yeah, I have seen the gold. Well, what does that mean? How much gold is there? So here's the question for Ted Butler. Where is the gold, brother? Is it in Fort Knox? Is the Chinese and the Russians, have they acquired it all? Where's the gold right now?
Well, I don't know, okay, because I've never been down to Fort Knox, and not that going down would do me much good anyway. I don't know. Look, I know that the gold wasn't discarded, okay. I know it exists, and I know a lot of gold exists. I mean, it's a relatively finite item, asset, but it's a very high-priced item. And there's got to be $10 trillion worth of gold in existence, not all in bullion form or whatever. So it's a legitimate concern that you're asking if the gold that the United States claims it has, if it's still there. But if the United States doesn't have it, somebody has it, because we didn't just throw it away. I think the more to the issue is those who have obligated themselves to, in addition to whatever gold is out there, to selling short in any form, whether it's on the COMEX or in other transactions, gold that they don't have and perhaps can't get. That's the bigger problem. And in the case of the COMEX, we can see what the concentrated short position is, both in gold and silver. It's much more egregious in silver than it is in gold, but it's still pretty egregious in gold. And that data is publicly available. And for the last year or so, the big shorts, in the 8, 10 big shorts, the CFTC counts them by the 4 and 8 largest traders in every commodity. In gold, not in silver, because silver hasn't moved that much in price, but in gold, these big shorts, are out more than $8 billion, or more than $1 billion each in losses, over the last year, for the first time ever, certainly excluding J.P. Morgan. Those guys are, pardon the term, they're gold. They're golden. They don't get hurt no matter what. But the 8 big shorts in gold, COMEX gold futures, have gotten hammered, to the tune of more than $8 billion as of yesterday's close. They're starting to take the realized losses. They never did that before. They're delivering gold. That's where all this gold is coming into the COMEX warehouses, is in response to these big losses that these 8 big shorts have had in gold, as a result of the price going up $300, $400, $500 over the last year or so. That's where the real concern is. These guys, these big shorts, these big banks, we call them bullion banks or commercial banks, are they going to be able to withstand this kind of financial punishment? That's what's going to, I think, if anything, break the back of of those who are manipulating gold and silver. Is it won't be the CFTC coming to the rescue or the COMEX. It'll be the big shorts losing so much money that they can't continue the game. After you've lost as much money as they've lost, which is the most they've ever lost in history. They never lost at all before. They always won. This last year is like a change, a sea change, a seismic shift in which the big shorts have gotten hammered, and I don't know, what's going to rescue them at this point. Certainly, it could be J.P. Morgan, but I don't know why they would. J.P. Morgan, they let these guys go. Let them. We'll start to see real price increases when these big shorts throw in the towel, which to me seems closer than ever before. So I think that's a big issue.
Ted, I've got a question on supply and demand in silver.
Okay.
and you say you started in 1985, and I mean, I was scratching my head through the 90s, pretty much any time metal positive news came out, the metals would get hit. And like yourself, I mean, I started digging, looking at supply and demand numbers. I realized there was a deficit. Certainly in silver, there was a deficit for years and years. And it seems that throughout the 80s and 90s that it may have been Manhattan Project silver filling that gap. But what's been in today's world, for instance, with this COVID virus, you've got 40% of silver production now offline. So there's a huge deficit. Where is that supply coming from?
Well, for the last 3 months, I mean, it seems clear to me that the physical silver that is coming to the market is coming from J.P. Morgan in the form of a lease, to other banks who in turn are selling it to the ETFs and perhaps others, but at least with the ETFs, there's public data. We can see how much goes in, and they list the bars and the serial numbers, so, it seems on the up and up. Prior to the last 3 months, I mean, I don't know about the Manhattan Project, but the regular, it started in the mid-'80s. I wasn't aware of it until 1996 or somewhere around there, that the central banks leasing both gold and silver to mining companies was the real source of how can you keep the price down. So I figured out, what was keeping the price down in 1985 when Izzy challenged me. But what I didn't admit is that it took me another 10 years to answer the question that you're asking, which is namely, once you keep the price down and we have a deficit, how do you keep the price down? Where's the physical coming from? Well, it took me 10 years from 85, 86 to 96. It suddenly dawned on me they were publicly reporting these gold leases and forward sales by mining companies, gold and silver, and that was the obvious explanation. It was a 1-2 punch. It was, hit them with the paper contracts on the COMEX to keep it down, but then you had to come up with some kind of scam or fraud to supply the physical metal, which was leasing, up until the turn or shortly after the turn of the century, but then decade rather, and century too. Now I think about it, but then we started going up in price. We went from 300 in gold, 500, 800,000, up to 1,900. So the price did go up, and silver went up, not the same way, sometimes more, but erratically. And we didn't have a deficit then but then the price started to come up. They increased mine supply. We lost in silver. We lost photography thanks to digital. And so there was a lot of changes, and we didn't have the same deficit consumption pattern that we had for the 65 years prior to 2005. So we've been, at higher prices. Mines have been cranking out more over the years than they had in the past. We're consuming more, of course. We didn't have any investment demand after April of 2011, when the sons of guns at J.P. Morgan engineered the famous price collapse from $50, down to, whatever over the next 9 years till recently. Investors don't buy when the price of assets go down. They only buy when it goes up, and J.P. Morgan knows this. So they exerted pressure on the price of silver and gold to keep the prices down, and they turned around and bought physical silver and gold, to their heart's content, to J.P. Morgan's heart's content. And that's how they got all the gold. I say they got like 25 million ounces worth of gold physical, which is a lot of money, and they're ahead about $13 billion because they got like an average price of $1,200 or so. they're still just even on silver because their acquisition cost is around $18, and they got 1 billion ounces. But now, for the last 3 months, this is unusual. We're seeing 100, 200 million ounces of silver go into these silver ETFs, and why the heck wouldn't the price be going up, especially since, as you mentioned, production seems to be constrained, et cetera, and there is big investment demand developing for retail silver as well as wholesale silver and gold. So the only answer on a short-term basis I have for silver is that J.P. Morgan's leasing. I don't think it's going to last long. I don't see how it can. And when J.P. Morgan finally refuses to lend silver to the other banks, I think that's the moment of ignition as far as the prices go. When exactly that will be, I wish I could tell you. I wish I knew. It would be that would be a good thing to know. You don't, but it's got to be getting close.
Ted Butler, you are the real deal. It has been fun to share time with you. Before I say our goodbyes, I do want to reach back out to Bill Holter. Bill, do you have any more questions?
No, I think we covered a lot.
Well, my goodness.
I would ask that, I don't know, maybe 2 months, 3 months from now, maybe we can revisit this and look at how the eggshell cracked open.
That'd be really cool. I want to thank you, Ted, for joining us today on JS Mindset. For those of you who are listening, remember you can find Ted at butlerresearch.com. I'd also like to thank J.B. Sleer for his help in helping us track down Ted today. J.B. is a frequent contributor to JS Mindset, and we truly appreciate his help today. Ted, thank you. You're the real deal. You're gracious. You're humble. Probably humble to a fault, but I just want to thank you for your time. You have certainly delivered on every one of our questions.
Thank you. It's been my pleasure.
Yeah, there you go.
Thank you, Ted.
We'll be back with you next week for another edition of JS Mindset. Again, remember to check out butlerresearch.com, and in the meantime, we send you our very best.